Hi everyone, you're all very welcome to another Alpha Capital Group market update video. Of course, today, big news in the US coming this afternoon with inflation data. The next bat of inflation data coming out in obviously the US is going to be pivotal for obviously short-term fundamental sentiment within the financial market. So whether you're a gold trader, dollar trader, FX trader, or indices are involved with the stock markets, you should be looking for some decent volatility today as we head towards April's CPI data for the US. Now, of course, if we look at the last number of months, we know that broader inflation narrative is still persisting to the downside. Obviously, we're still getting those gradual incremental declines. We went from, I suppose, 9.5%, 10% in some locations, back down into kind of 5-6%. And we're still trying to work ourselves lower off the back of these, as I said, higher interest rate policy by global central banks. So, as I said today, all eyes is really going to be on the inflation data, and of course, just kind of relatively digesting how that market sentiment is going to take on board the news. Now, of course, we are expecting volatility on both sides, so this is where it's important to be aware of high-profile economic data events, because of course, if you trade into it, let's say you're running positions, there most likely will be, in a lot of circumstances, slippage. And of course, the slippage will only be allocated at what the next available price that the market is quoted at. So of course, you could see $5, $10, $15 as gaps in gold. You could very easily see similar scenarios in the S&P, the Nasdaq, Dow Jones, when we see kind of a 0.5%, 1% gaps potentially arriving, if the figures, of course, are well above or below expectation, in line with that as well. So just be kind of wary of that today for those who are trading this week. Obviously, given that we've had the Easter bank holidays, Friday and Monday, we're working back into the markets today, obviously being Wednesday. So all eyes is really on the price action over the next couple of days, broadly speaking. So you just have to be wary of that in the background. Now, firstly, as we look at the economic calendar today, okay, so the idea here is that when we have the US inflation coming out at 1:30 p.m. UK time, all eyes, as I said, is going to be on CPI. So you've got the core and headline figures month on month and year on year. So if you look at the excluding food and energy figures, you would see that the expectation is for a 5.6%. The previous, of course, was 5.5. So that's basically saying, in an analytical perspective, that these regular declines that we've been seeing every month is set to kind of start to slow down. We're going to start seeing more kind of gradual declines rather than kind of 4.4, 0.5, 0.6% every month. And of course, this month they are expecting a leveling out in the inflation as well. So of course, if we are to see a CPI coming in at 5.2, 5.3%, it's beating expectations, it's beating the consensus, it's beating the previous figure, then you're most likely going to see risk assets around. You're going to see probability in buying of gold, you're probably going to see weaker dollar, and you're going to see bullish indices as a result. So it's just about important to know that if you are trading short-term data, you are, let's say, trading news, you're scalping, or you're trying to navigate in around the data, anything less than expected for a CPI figure is obviously good for risk assets. So good for euro, good for pound, good for gold, good for indices, broadly speaking, in line with normal market, I suppose, confluences and correlations in that regard. Now, of course, as well, we do have the month-on-month figures. So they are expecting year-on-year to be slightly higher than expectations. But of course, month-on-month, they are expecting it just to be gradually or a little bit lower, 0.4% as opposed to 0.5. So of course, if we do see those, like, let's say it's a 0.2 and a 5.3, good figures, right? Overall, they're the good figures, and overall, we should probably see indices move in that regard as well. Now, with that as well, we do also have the price indexes for the core as well, so keeping an eye on that. And of course, the CPI figures, including food and energy, which is coming in at 5.2% as opposed to the previous of 6%. So, of course, this is also going to be another one to watch. So this excludes food and energy, which, of course, as we know, has been huge outliers in the inflation story over the last 18 months or so. And of course, this is inclusive of it. So if we see that factor in, we see, let's say, a 4 print on the total headline number, then of course that's going to be good for markets. You're going to see broader buying in indices as a result of that. So just be kind of wary of that. Now, at 1:30, we also have the Gunda speaking out of the ECB. We do also have Bailey speaking at 2 p.m, Governor Bailey from the Bank of England also speaking. And at 3 p.m. today, we also have Bank of Canada interest rate meeting. Now, of course, what happened last time out, Bank of Canada opted to pause. It was the first time in months, many months, that the Bank of Canada opted to not to increase its rates. They stayed stable at 4.5%. They are expecting that to remain stable today. So what happened over the last year and a half is that every time the Bank of Canada raised its rates, the Fed was doing the same thing. Okay, and of course, last time out, the Bank of Canada stayed, they halted, they paused, and of course, the Fed went on to continue raise rates again. So we just have to be kind of aware of that dynamic from a central bank fundamental perspective, just about being aware of market dynamics in that regard. Right now, of course, 3 p.m. is going to be volatility as well. So you're going to be looking at 1:30, of course, the CPI print. You're going to be looking at that follow through into 2:30 p.m., which, of course, for UK traders is the US session open. And then, of course, 3 o'clock, you have that all important Bank of Canada meeting. So you're expecting quite a decent bit of volatility, really, from kind of 12:30, 1 o'clock into really the European close at 4:30, and just being kind of conscious of the volatility that will ensue between those trading hours, and just kind of being aware of that. As I said at the beginning, if you're a short-term trader, medium-term trader, or swing trader, just be kind of aware of the volatility in the markets, okay? Just to make sure that you've position sizes factored in accordingly. You're aware of the potential for slippage, and you're not potentially getting caught out in the wrong side. Even if you are trading, you're just bringing your position sizes down, ultimately giving you more control, which means that if a trade were to go against you, it's not completely killing your account. And that fundamentally is the most important thing today. Right now, at 7 o'clock this evening, we do also have the FOMC minutes as well. So we have CPI day, we've got BOC interest rates, and of course we've got FOMC minutes coming from the most recent FOMC meeting as well. So 7 o'clock, that would be interesting as well to see if there's any sort of follow through into the US session close, as I said, into that 9 p.m. time. All right, so that's kind of where we are today in terms of the economic calendar. Of course, tomorrow as well, if we look at the data tomorrow, we do obviously have the IMF meeting starting obviously Thursday and Friday, so that's going to be a 2-day kind of Congress. Tomorrow or overnight, we do have Aussie data, we do have Chinese data, we do have UK GDP data in the morning, factored in with also more US, European and pound data through kind of the stagnance through tomorrow morning into tomorrow afternoon at 1:30, where we have jobless claims and obviously PPI numbers as well. So you're going to have little bits tomorrow back and forth. I know Thursday, traditionally speaking, tends to be the busier day of the week in terms of data, but given we have CPI this week, we have Bank of Canada, we have the FOMC minutes tonight, I wouldn't be surprised this week if Wednesday was our busier day because of that. Okay, so just be kind of aware of that. Friday, really not too much happening in terms of the data front. So I think a lot of the action will be done Wednesday and Thursday into obviously the weekend. And given, of course, that we had a Friday bank holiday and of course Monday as well in some locations off the back of Easter, we're kind of really looking for the volume, the volatility to get back to normal. And there's really no bigger catalyst for that than the CPI data that's coming out this afternoon as well. So of course, just be kind of conscious of that as well, as always. Now, if we look at broader price action, let's go back and look at kind of the data, the broader price action in the markets really over the last week or so, through the Easter holidays and kind of where we're reflecting at now. Overall, you will see that we've had broadly weaker dollar across the board. Right? If you're looking at the FX crosses, you're looking at gold, you're looking at the indices, we broadly had that kind of heightened or increased investor sentiment into risk-oriented assets. And for those of you who don't know, the dollar is effectively the safe haven, so it's going to be your kind of your bridge, your cross against volatility. So anytime there's volatility or uncertainty, in most circumstances, people will be buying dollar. Now, of course, with the financial instabilities and this kind of weaker dollar narrative that's been posed in the markets over the last obviously month or so ago, gold has then been the backing hedge, right? So gold has been the hedge where people have been, a lot of institutions, a lot of people, the traders have been buying gold as that hedge against volatility. So just be kind of aware of the two scenarios there in terms of the hedging, in terms of the volatility, in terms of mitigating that as well. All right. Now, of course, if you look at the DXY, we've had that kind of fairly steep decline to the downside from this kind of bigger area that we talked about up here, this kind of 105.50 level from the early mid part of March. It's just been a fairly clear descension to the downside back into this 102 level. And actually on Wednesday of last week, we actually technically broke structure. So we broke this internal kind of bearish moving trend cycle analysis that's been playing out for the last, as I said, 2-3 weeks or so ago. It's been continuing to churn to the downside. So we broke structure last week. We came all the way back up into this value area here around 102.50, 102.80 in the DXY. We've started to move lower again back into this 102 level. So of course, If the CPI figures comes out lower than expected today, we should be most likely looking for a weaker dollar. You're really looking for that dollar continuation to the downside to really continue playing out. Vice versa, of course, if we do see the higher than expected CPI, the data is not coming down as quickly as market consensus is obviously looking at, then of course you're going to see dollar rise off the back of that. Now, of course, yesterday in our Discord, we did upload kind of the expectations for where institutions expect the inflation levels to be this time around. So, of course, the big talking point, of course, was the median case scenario, which, of course, was coming in at around about 5.1%. So I know we obviously looked at the economic calendar headline was around about 5.2. If you look at all of the institutions across Wall Street, and of course, the globe broadly, including obviously Barclays as well, included in that, you're looking at the broader average being 5.1%. So, of course, if we're seeing, as I said, four figures, four prints, 4.9, 4.8, let's say, going to be a positive thing, and we really should be looking for that weaker dollar play to continue as well. So just going to be wary of that in the background. Of course, we'll siphon or we'll share those estimations again on our Discord this afternoon into obviously 1:30 p.m. So next on our list then is gold. So if you've been looking at gold, gold has been quite an interesting story over the last 3 weeks because, of course, we've just been on this massive gold rush. Ever since that pullback into the 1800s, 1820s at the end of February, we've really just kicked on again. We've really just kind of cemented more upside to gold in terms of that move back into this $2,000 level. Now, of course, structurally speaking, if you're looking at gold more pointedly into the Easter break, and of course, after the Easter break, we had that very, very aggressive move last Tuesday, right? So for those of you who are trading actively, you would have seen that aggressive move. Now, from an institutional perspective, apparently it was all down to the Jones numbers, but a lot of the actual movement actually started to come pre-Jones. So you can actually see the Jones numbers that came out at, I think it was 3 o'clock. If we go down to the 1 hour chart last Tuesday, you can actually see the buying coming in ahead of the open, ahead of the data, and of course into 3 o'clock then we had that continuation upside swift move into this 2030 level. Now, when we look at, pare it back a second, look at the broader perspective, we had this fairly clear consolidation in the region. We had that initial short-term break within the region, and then we had that secondary momentum swift to the upside, of course, last Tuesday. Now, from Tuesday into the early parts of this week, or latter end of last week, we had that initial break to the upside. We had that very, very swift reversal because, of course, on the 1 hour time frame, if we look at it, you can see that gradual, clear descension back into that value area. Right? So that value area where we broke up from right about 1980, 1985, that swift upside movement was very much undone because, of course, the price action pulled back to that key liquidity area, to that kind of prominent value zone or point of interest. This is exactly where we rallied from. So Monday into the open, we have very, very clear, quick reaction from that 80-85 level. Since then, it's just been very much tilted to the upside. So again, of course, with that weaker dollar, to go back to that DXY, so since Monday, that weaker dollar, of course, moving back in from 102.80 back into 102 has allowed this gold move to kind of prosper again. So we've gone from mid or early 1980s all the way up again to 2020 on the dollar prints. And of course, what's actually happened since then is following this correctional retracement back into this value area here, we've now, of course, broken structure on the upside. So all of this kind of short-term bearish order flow, lower low, lower high scenario that normal traders would look at from a trending perspective, it has now been completely taken out. We had this kind of short-term area yesterday, short-term tops around 2000. And of course, overnight during the Asia session, we continue to churn higher by the price action, but comfortably above 2000 into this upper area here at 2020. So from here now today, it really just depends on how does the price action react. Do we get pullbacks into this value area down here, mid 1990s, maybe potentially this 2000 level? So somewhere around this area would be worth watching, or does the price action ultimately continue to trend in this upward direction and looking for a new impulse to the upside? I suppose that's going to very much come from the CPI today. Does the price action continue turning higher, or do we get a pullback into this level down here? And I think that's going to be the break or down scenario. Is going to come from the CPI. So of course, just be wary of that from a short-term trading perspective. It would be not surprising today if we saw gold weaken, or saw dollar weaken, should I say, and saw gold prices continue moving higher. Given we haven't mitigated this area here, given we haven't mitigated this area here either, both of these two decisional areas still could potentially get taken out. So that's why I think it's important to wait for the volatility to come in, allow the markets to initially move, because of course the algos, the institutional trading algos will be in full flow. Allow that markets just to breathe, and then you'll have clarity. Once you have clarity, then if we start to see the markets coming off these value areas, then of course we should be looking for that upside swing, but the markets is looking for that next run up higher. So of course, just be kind of wary of that. Euro dollar is again quite an interesting one, because of course euro dollar, very clear dynamic in the last week or so. So we've had that initial break, obviously through the middle part of March. Then we've had this bullish order flow, consistent higher high, higher low trending price action scenario, which is great. When you look at the order flow as well in the 4 hours, it's just very clear price action. So of course, most recent dip to most recent highs, bringing in fib structure as well. We've had a very, very clear reaction from that kind of 707, 786 level that we tend to look at. So of course, if you look at it as well here, similar scenario, back to that 707, 786 level, new highs, back down again. So we're getting orderly trending price action structure. But at this moment in time, into today's CPI, market dynamic is very much held here between kind of 109, 109.30, and looking to see, do we get that break? Do we get that upside break and ready for price action kick on? I think if we can take out this area of liquidity here, this kind of consolidationary, short-term consolidationary zone, I think really then you're looking at an initial retest of highs with probability of kicking on again. On the downside, of course, if that doesn't play out, you're really looking at price action, most likely coming back down somewhere into this region again for double mitigation or double test of those lower levels that, of course, where we got that reaction on Monday from that dollar DXY as well. All right, so that's euro dollar. GBP USD, very, very similar, in fact, to euro dollar in course. Broader time frames, of course, if we look at it, it's just continued to turn higher. So we talked about this kind of break of higher region, which was obviously fairly emphatic last week. You look at the short-term order flow, higher highs, higher lows. Then, of course, you look at the most recent reaction, again, similar move to what we saw EURUSD. And of course, we're back into this value area here between 124, 124.50. And that really is going to be the catalyst today. Does the price action move lower, back into some of these levels down here, or does the price action ultimately kick on right to the upside? Now, of course, if we pair this back, let's just go back into higher time frames for a second. Just move these arrows for a moment. We look at the higher time frames. All eyes is very much poised on how we react at this level. So today, of course, if you were to look at the broader regions, this 124, 124.50, no coincidence that we're seeing a little bit of consolidation restructure around this zone, broadly speaking. So we're going to keep an eye on that, on that area today to see if there is any sort of reaction, broadly speaking, as well. Sorry, guys, my camera is just deciding to fall off there. So that's very much kind of where we are on GBP USD at the minute. All eyes really on price action, as I said today, with the fundamentals. So I think if you can combine the sentiment, the fundamentals, just wary of volatility, mark up your levels, wait for the price action to come to those levels rather than try and chase entries, I think you will be in a far better position because of that as well. All right. Lastly, then in the FX markets really is this dollar yen story. So of course, the dollar yen story, we've had continuous movements back and forth because of course the yen has been probably in the last 2 years the most volatile FX. Okay, broadly speaking, it's the one that had the most significant declines against the dollar in the last 18 months, and it's the one that's probably seen the most significant strength in terms of that parity, in terms of that leveling out of cycles, right? So we look at the markets move obviously in cycles. We've had that weaker yen cycle. We're now starting to see that little bit of a temporary rebate in yen strength, which of course allowed us for that correctional 1,400 point pullback, or 1,500 point pullback, should I say, over the last kind of 6 months or so. But now we're seeing dollar strength argue up again. Okay, so we've had that clear correctional, very nice trending structure. Didn't quite get back to this key permanent level at 129. Of course, we found bottoms. We talked about it in previous videos. Of course, we've taken structure out. So again, this lower low, lower high scenario in terms of the order flow has very much been broken. So of course, when you have that scenario to play out in, you're then looking at, well, what's the next move in price action? So after we formed that 133.50 highs, we saw that correction back down into this medium term liquidity point of interest value area, 130.50 into 131. And of course, over the last week or so, we've saw very steep inclines in dollar yen, where we've gone from 131 all the way up to nearly 134 off the back of, most likely, and in despite of that, weaker dollar. So even though the dollar has been quite weak against the euro and the pound over recent weeks, we're still seeing the dollar outperform the yen. So of course, if you're looking at euro yen or pound yen, you're seeing very, very aggressive bullish trends. And of course, you have to be able to look at the cross variant analysis between euro, pound, yen performance if you are trading obviously those pairs. But of course, the dollar yen is your kind of your backbone if you're trading major assets. So just kind of be wary of that as well. All right. So that then brings us into indices. So where we've been obviously with that mid-March high on the DXY over here at 105.50, again alludes back to correlation with markets, correlation with asset classes. And of course, what have we seen since then? Well, of course, we know that the broader correlation with markets is that, well, when you've got weaker dollar, you're looking for stronger indices and vice versa. And of course, that's exactly what's happened. When you look at broader assets since that dollar high in mid-March, we've just seen the S&P, the Nasdaq, the Dow Jones, European indices as well, garner momentum to the upside back into some of these value areas where we'd formed early February highs. So of course, for early February highs was in that 4150, 4200 level. And if we look at the S&P more specifically over the last week or so, within the price action, that's exactly where we are today. We're back into that value area. We're back into that prominent area of interest, 4150s. And I think that's going to be the prominent area today. That if we see this potential weaker inflation story, that's really what we should be looking at today. We should be looking at indices continue to try and progress to the upside. And of course, can we take out some of those early year highs? And in that regard, then would be obviously February highs. All right. So we just have to be kind of very, very conscious of that. If you look at short-term consolidation over the last week, so let's just tidy this up a little bit. Kind of from a short-term perspective, there's been kind of some interesting moves. But if you look at where we have been really into the early mid part of April and of course into the Easter vacations, just very much back and forth, very much back and forth. We've got a very, very clear consolidation restructure here, which of course did try and break out today. So if you want to even include the whole range in it, really, because of course we've got cycle analysis up and down short term, this is the range the price action is currently trading in. So now I suppose from here, it'll just be, as I said, all eyes to see whether we can break through that 4150 early April highs, progress through into 4200 and see does that upside continuation occur. Now, from a short-term trading perspective, if you isolate price action, if there's any sort of selling, you really got to be looking at these lows down here. So of course, 4075-ish should become a very, very prominent level. You do have a smaller liquidity area down here around 4080 from a short-term perspective as well, because of course we've had V-shaped sell-off, retest of lows, strong buying reaction back into region, and of course we're in this consolidationary state, as I said, into CPI today. So really CPI is going to be a big driver of how market dynamic plays out, of course, through the afternoon. So just be kind of worried about that, as I said numerous times. Nasdaq then last on the list, as I said, or secondary on the list is the Nasdaq. So again, similar to S&Ps, as I said, from those mid-March lows in here, we've seen Nasdaq progress very, very stable, consistently to the upside. So we've gone from 11.8 really into 13,200. Now, of course, if you're looking at Nasdaq since then, you would see this area that we talked about last week. So this daily 4-hour area of liquidity down here between 650, 700, I think is really kind of, if you're looking at any sort of pullbacks in indices or any sort of downside reaction, this is probably where you'd be looking at the Nasdaq to come to short term. Okay. Now, obviously, if you look at price action since then, since this massive run up into end of March, early April highs, which as I said, established around 13,200, 13,250 on most exchanges, you're really looking at this short term bottom here at 12.9 as well. So you've got short term bottoms here in April at 12.9, major prominent kind of liquidity area between 12,650, 12,700. So those are very, very prominent downside targets should markets sell off today. Now, big if, but of course, if we do see that bearish price action coming into play, these become two very, very interesting targets. And for me, as I said, 12.9, this area between 12,650, 12,700 should be kind of prominent focal point for downside price action. Of course, if we start to see buyers coming through, and let's say, for example, we see straight buying coming through from this 12,950, 13,000 level today in the value area, intraday value area, then you're really looking for price action to take out this high, which was formed yesterday, of course, at 13.1, and really looking to see can the price action then push through this April highs. And of course, that then brings in 13,250, 13,300 as upside targets. So it's just about having clarity in terms of rationalizing the price action, having a clear structured approach, mitigating the volatility, and then reacting accordingly. Above all else, that's the most important thing. Lastly, then in US is obviously the Dow Jones. So clear volatility in the markets. We've had consolidation moving obviously laterally. We've had that break of structure we talked about. We've seen that gradual grind back up Now, from where we were obviously mid-March, that kind of dollar peak, we've seen very strong progression to the upside. So Wall Street, Dow Jones gone back or rallied from this 31.5, 31,800 level all the way back up into nearly 34,000. So we've gone 2,500 points, potentially speaking, by the end of today on the Dow Jones in a matter of weeks, which shows that the volatility is very much inherent present in both scenarios, both the buy side cycle but also the sell side cycle. I think it's just being kind of aware, having clarity with that, and just mitigating the price action. So, of course, as I said today, volatility will be your friend, hopefully, if you can get on the right side of these directional prices. Now, as I said, short-term perspective, market dynamic 33,300 this week, and it's the early parts of April has been a clear consolidation point. So anytime we've come into this level, we have actually seen buying, supply and demand actually come back in up as far as this peak here at 33,800. So I think that's really the peak here today is, do we get selling off of the inflation back into this value area down here, 33.3s, 33,400s, or do we ultimately see Dow Jones strength continue and ultimately kicking on to these higher time frame levels back to where we were in mid-February and back into this 34,200, 34,500 level on Dow Jones? And I suppose as where we are today, that's really the best case scenario. Like we have the estimations, we have the forecasts. Now it's about watching the information at 1:30, right? Trying to kind of gauge the company and just obviously factoring that into consideration. Now, moving across to Europe, FTSE, DAX, and Euro Stoxx to finish. FTSE has been on a complete rally. So where we were obviously into middle of March, we had that very, very clear sell-off all the way back to this daily area down here. So if you go back to higher time frames, this line here at 72.60, this was the midpoint of this previous range. This range where we had all through time before we had this bullish break into the early part of 2023, price action came all the way back down to this value area. So this value area was rejected very, very prominently. And that, of course, then brought us into the structural point. Well, what do we mean by that? Well, we had very, very clear bearish price action into this medium-term value area or midpoint range. We then had the break of structure taking out this most recent high, as I said, from 17th of March, back down into key prominent liquidity area here around 73.50. And of course, we got an amazing rally from the 73.50s all the way up, all the way up, all the way through this short-term highs here just underneath 7,600 and approaching back into where we sold off from in early March, 79.60, as the indices are continuing to churn higher. So at this point in time, FTSE is still very much in control to the buy side. We've rallied through 7,600, we've rallied through 7,700, we're now above 7,800. It looks like very much like the market dynamic is still continuing to kind of chug itself higher, churn itself higher back into this value area up here, as I said, around 7,900, 7,950. I think that should be the focal point for this week to see, as I said, if the inflation story comes out better than expected in the US and we see US indices rally, you're probably going to see that migrate back into Europe as well, because of course it'll drag European assets up in sympathy with it. Now, the one thing I would also say is with the bank holiday weekend, of course, we did have this big gap. So, of course, we had this gap, gap up, comes back down. Do you call that a fill? Probably marginally, you might call it a fill. On some exchanges, you probably will. Got a fill there around about 77.50, and the market is kind of churning higher again, as I said, back above 78. So today, as I said, short-term perspective, if you're looking at intraday levels, intraday perspective, we've got a nice little liquidity area left behind here with this buy-side imbalance. So, of course, if there is any sort of short-term pullbacks, look for a move back into this 77.80. You could potentially try and break through this level on maybe a really, really sharp wick. And of course, if we see this order flow being taken out today on the downside, look for a move back into this 76.50, which of course then creates another higher low scenario for potential kick on to the upside as well over the next few weeks. So as I said, whether you're buying, whether you're selling, you've got a dual systematic approach or rules of engagement, which I think is important. You've got clear parameters for entry, which also is extremely important. And then you're just kind of gauging volatility, as I said, trying to mitigate it around that as well. All right. Lastly, then, to finish off today, we've got DAX and Euro Stoxx. So DAX volatility is, as I said, still very much continuing to the upside. Market dynamic over the last few weeks has just plowed through back into this 15,700 level. Now, as I said, today's volatility should be eyed very, very closely because, of course, every time the DAX has come into this level, we've seen it stutter, we've seen it fall, we've seen it actually come back to lower levels. So just be really kind of cautious of that. Now, when you look at the daily as well, over the last few weeks, not really too much happening, right? Of course, into the Easter rally, or into Easter. We obviously rallied. We're seeing price dynamic here, 15,700. But of course, let's see what happens today. Do we get that kind of elongated push higher? Do we get that continuation to push higher to the upside? Or do we actually see that falter and fail? I suppose short-term perspective, keep an eye on the volatility because, of course, European indices, DAX broadly speaking, not really doing a terribly whole pile. Of course, we did have consolidation over here. We did have break of structure to the upside. We have come back down. We have ground up, and of course, over the last week or so, you'll see that the price action is holding this 15,700 to 720 level. You've got multiple reactions from this liquidity area today. So again, faltering to see this could very easily be broken today if we see that weaker inflation story and we see US indices rally. You could see DAX fly with it. So just be kind of cautious of that if you were to consider selling. All right, that's the only downside risk there. Same again with Euro Stoxx. Very, very clear rally all the way back into kind of key all-time highs or close to all-time highs, as I said, around this 43.50, 44, 44.50 level. Now, of course, today we are trading into 43.50s at 43.38. Obviously, with session highs being this morning at around about 46, 47. So we are seeing price action still remain big to the upside. But of course, all eyes on the price action today. See if we do get that break or bounce from this pivotal area here as well. All right, so that's pretty much where we are, folks. All eyes, as I said, at 1:30, 3 o'clock BOC, and then of course tonight FOMC at 7 p.m. as well. So as always, folks, trade safe. Just be disciplined. Just be wary of the volatility. That above all else, be wary of the volatility today. You will have slippage. You will have decent volatility in both directions, or we're hoping for that anyway, at the very, very least. And then, as I said, if you're trading 1:30 data, just be kind of focused on what are the correlations between the different asset classes, what are the different scenarios. So if it's weaker or stronger inflation, what should you be buying or what should you be selling? Because above all else, that's the most important. All right, trade safe, everyone. Have a great week.